Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, October 4th, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing good, Will. Thanks.
All right, let's start off with look at what the market's been doing this past week. Was look at the market letter.
All right, well, we had a third losing week last week. The Dow Jones and S&P 500 were on a 6-day losing streak as we went into the week, up through Wednesday last week. They were still kind of struggling with the Federal Reserve hiking rates by 0.75 point the previous week, and we ended up with the 10-year Treasury, I believe, on Monday or so, flirting with the 4% area, which is that would have probably given the market even more trouble. And then we had the 2-year Treasury yield actually hit 4.32, I believe, Monday or Tuesday. That was the highest mark since 2007. And then we had a little bit better economic data came in that added to the volatility. In fact, I think it was on Tuesday, I believe, we had got some economic data came out. Manufacturing was up a little bit better than we thought. And we had the Dow surge about 350 points. Of course, we've talked about a lot of times, in this market, good news ends up being bad news because that just strengthens the Fed's case that they need to be hiking rates even more. So the Dow erased that 350 point rise in the morning, ended up down about 150 points. We also had several committee members come out during that day and during the week saying that we need to keep these rates higher for longer. We're going to tackle this inflation, and just investors are starting to get a little bit shaky. Even some of the Wall Street bigwigs are starting to say that enough's enough. We need to see how much what's going to happen here with the economy, whether the rates, we're going to see inflation if it's peaked or not. And then on Wednesday we had another big relief rally. We had the Bank of England announce that it would start buying bonds to prop up their economy and pension programs, and that kind of got the bulls thinking, okay, well, now we're starting to get central banks are starting to blink, and maybe that's going to fade, go across the different countries, and we'll start to see more more banks slow down. I think the Dow was up. Let's see, it was up about 548 points. The NASDAQ was up over 2%. Small cap Russell 2000 was up 3.3%. So that was one of the strongest days I think we've had since July 19th. And then we got slammed with a good jobs report. And again, good news is bad news. And we saw that the initial jobless claims fell below 200,000 for the first time since, I believe, in April, something like that. Yeah, for the first time since April, they fell 16,000. So that was kind of a bit of a surprise. And then then we saw yields move up higher because one of the main mandates for the Federal Reserve is that they want to see weaker employment numbers, and that was going the wrong way. So that sent stocks down sharply on Thursday, and then again on Friday. And then also on Friday we got the August PCE came in. That was hotter than estimates, and I think it's actually more than what they expected. It showed the core-PCE was up 4.9% year over year. That was up from 4.7% the prior month. I think analysts were only looking for about a 4.4 or something like that. So it was hotter than what we thought. That triggered another sell-off. Yields came back down. Oil prices also traded lower. We had they were briefly below $80 a barrel before closing right at around 80 on Friday. The yields moved up on that higher inflation number again, and we had a big sell-off. Energy on a little bit of was actually one of the better performing sectors over the week. But the rate-sensitive sectors were some of the weakest market groups. That included utilities, REITs, and consumer staples. We're at a point now where As if rates stay up higher, those sectors are probably going to underperform going forward for a little bit. And those were followed by losses in technology and consumer discretionary communication services and industrial. So, more of the growth sectors underperformed for the week. So anyway, we closed out on Friday on a sour note. That everyone was kind of glad to say goodbye to September. That was one of the worst months we've had. I think it was since March 2020. So we ended up a lousy month, and most of the major averages were sitting at new lows for the year. The Dow was down about 2.9%. NASDAQ was down 2.7%. But the Russell 2000 actually outperformed, and that's kind of one of the things you want to start seeing as you're getting close to a bottom. It was only off 0.9%. But the technical condition, again, deteriorated. For as a third week in a row, we've seen, we have several indexes at new 52-week lows. All the indicators are pretty much in negative territory, but they are very, very oversold. 14-day RSI is down, I think, below 25 or so on several indexes. The Dow Jones, the S&P 500, Dow Jones Transports, and also the semiconductors. Those indexes actually closed at their lowest level since November 2020. So you've lost, almost 2 years of market gains in those indexes. We did see the NASDAQ and Russell 2000 hold above the June lows, but I think they're probably going to. They may break it, but of course we had this 2-day rally or something. But anyway, we've seen the Dow Jones and S&P 500 are close to retracing 50% of the rallies off of the lows from back in March 2020 until the beginning of this year. But all this that we're seeing going down and going down and going down, everyone says, is this the bottom? Is this the bottom? Generally, especially when you have something like this, you're going to see a capitulation bottom. Now, yesterday, people were, I got emails. Was that it? Okay, I had a big spike and turnaround. And then today, even too, with the big turnaround, I would, if we had seen yesterday open up, say, down like 400 points or something, and then all of a sudden come up and finish with a big up like that, that would have caught my attention, and I would have started to think, maybe that may have been it. But we didn't get that. We just kind of gapped up open at the open, and today we gapped up higher again. And again, some of that is yesterday afternoon. We had New York Fed President Williams came out, and he was talking about that he sees a sharp fall in inflation next year. He thinks it'll get down to 3% and probably back to 2% on there, if not the end of the next year, to 2023 or 2024 or something. That you get a lot of optimistic traders out there. I think some of them may not have been around for bear markets, and they're looking for a Fed pivot. The fact that the Bank of England, started to buy bonds, some of them took that as a sign that we're going to be, the more central banks are going to start easing or backing off of things. We'll have to see. Now, also, but as far as the internals go, the AD lines, they were making new lows from this sell-off. We also saw new 52-week lows continue to expand. The NYSE recorded over 1,000 new 52-week lows on Monday. We're also seeing investor sentiment. Now, this is a contrarian indicator. This could mean that we're are close to a bottom. Investor sentiment is really at an extreme low. The American Association of Individual Investors, they showed 60% of retail investors are bearish for a second week. We've only had them that high 4 times since the start of that thing. The last time was back in I think it was 2009 when we hit a bottom at the financial crisis. We even have the professionals kind of throwing in the towel too. Active investment managers exposure index, that's all the way down to 12.6%. So they're basically in cash. Now the reason that's a good contrarian indicator, because they're all out right now, and they're that bearish. They've got a lot of cash on the sidelines. So when they decide to come in and buy, they have a lot of money to back it up with. That 12.6% is down from 71.6% mid-August. So then this last month they've just been liquidating probably every up move we have. So anyway, we got third quarter earnings coming out in about 2 weeks. I think we're going to see continued volatility going into that. We have a lot of you're reading a lot of analysts are starting to trim estimates. There's a lot of companies that build up their inventories a little bit too much. They've got excess inventory right now as things slow down. And I said that we're looking probably at for the targets last week. I thought we could see the downside target for the Dow get down to around 27.9. If it retraces 50% of that whole move between March 20 and January 2020, then that target then would become 27.580, 27.6, which, well, at this point now we're about 2,800 points away again. The S&P 500, a 50% retracement level would be around 3,490, 3,500. I still thought if this doesn't last, if this little rally here doesn't stick, I think that's probably where we could probably see it bottom out. And then NASDAQ, which has already retraced 50% of that rally, it does have support around 10,268, 10,3, something like that. So that might be an area where we could see the NASDAQ try to bottom out. But there's not a lot to like despite these 2 days. A little bit surprised at how much that we've rallied these 2 days. Of course, we are getting weaker economic data. Yesterday, construction spending fell twice as much as they thought. It was down 0.7%, and they were looking for minus 3.3%. And then you had the ISM manufacturing index was almost down to contraction. It was a 50.9, down from 52.8 the prior month, and then we had new orders fall to 47.1 from 51.7 the prior month. Now, one thing for that, because of the slowdown, we did see yields move lower on those reports. And of course, anytime we see a little downtick in yields, the people are buying the stocks right now. But 10-year actually touched 3.67. We were pushing 4% just a little bit ago, and then it landed at 3.72. The 2-year actually slipped all the way down to 4.1. So we had a big reaction between Fed President Williams and then that economic data being so lousy to give us a big spike like that. We did see a jump in oil prices, which is kind of a little bit contrary because we had the U.S. dollar fall yesterday and today at a pretty good clip because of the lower yields. But the higher oil prices basically is that I think OPEC meets next week, and they're talking now they're going to cut production. They might cut it by 500,000 to 1 million barrels a day to try to keep prices up. That's not going to go over real big. It's actually the OPEC Plus group, which is going to meet in Austria. I don't know if the Russians will be able to go to that or not, but it's a little bit surprising that they are actually, pushing for that big of a production cut. Although the demand has been going lower. That's why we've fallen from above 100 down here to the 80 range. So today, again, we're getting a little bit of follow through. Came in, factory orders were flat for August. But we are seeing, we did see the U.S. dollar fall again for a second day. Russell 2000 small cap was up it's up over 3% today. That's good. You want to see the small caps leading if we're going to try to be finding a bottom in here. And the Dow is up about 800 points. We're up about 709 now. I don't know if Twitter was stopped for trading a little bit ago because I guess the deal with Musk was going to go through. Okay, it's not trading it, I guess, yet. But if we see that go through, we could see another spike at the end of the day if they open up trading for that. And that's good. Twitter's going to go from 47.95 up to about 55. So it'll be up about 20% on the day. So anyway, like I say, we're having a second day, a nice follow through to what we had yesterday. We'll see how much this lasts. I certainly don't know this is a bottom, but we'll start to look for things that would give us a little bit more confidence that we're closer to a bottom.
All right. So So last week you were pretty pessimistic, but we've managed to put together the best 2-day rally since the end of May, when we had a 6-day win streak and the Dow Jones gained 6.2%. Are we finally at a tradable bottom where investors should start to add stocks back?
Well, you know, like you said, we're having two exceptionally strong sessions in a row, and that happens when you get in a bear market when the tides start to turn a little bit. They jump all in, then they jump all out. That type of thing. It's, I still would consider this more of a relief rally. Back in what was it, the end of May, if you remember, we thought a lot of analysts were saying, well, maybe the Fed's going to slow down here and not raise 0.75 of a point in June. And we had like a 6-day rally, and the Dow was up 6.2%. And then when they found out, okay, well, they're still going to raise probably 0.75 of a point, we went sideways for about 3 or 4 days, and then that's when we made the new low in June. And another thing is, this market was so oversold after Friday. It was as oversold as we've been since March of 2020 at the start of the pandemic. I think the MarketEdge S&P short range oscillator that Kramer's always that's his favorite one. I think it was somewhere around -12 last week on Thursday or Friday. So I mentioned in last week's Friday's newsletter that we're overdue for a bounce, and we're certainly getting it. That's for sure. Now, what would make this a little bit different if it would be the start of maybe a bottom? And I don't think that we're going to just see a big V shoot up, but there are a couple of things that we would want to look at. There's a lot of upside resistance tests on these charts that we can look at, but the big thing here in the last couple of days, it was of course the Bank of England blinked, and then we also I'm sorry. So they're buying bonds. Some traders, I guess, are hoping that we're going to start see other central banks start to maybe saying let's back off a little bit and see what kind of juice we have right now. What's going on? But after that, okay, the last rate hike, we've seen a lot of kind of weak, except for the jobs report last Thursday. We've seen some kind of mixed to weaker economic data. That was including manufacturing and factory orders. New orders were weaker than expected. So that shows that the Fed's tightening policy is beginning to work, as we're seeing the economy slow. Now, tomorrow we get tomorrow's going to be a big day for the market because we get the ADP employment report, which will be big because that's going to show you whether how in private payrolls how much they're falling. Now today, one of the reasons we got another shot in the arm was we had the JOLTS came in, and now the headline is, okay, the JOLTS show that we have 1.1 million less job openings in August, which is that's a great headline. However, we still have 10 million job openings, so it's not like oh boy, here it is. The jobs are going out there. Yes, it's still stronger than what I think the Fed wants to see. In fact, I checked the FOMC, the CBE Fed Watch tool today to see if maybe we're seeing expectations come down to maybe where we're looking at maybe a half to a quarter at the November meeting, and it hasn't really moved. We're still at about 65% of probability that we're going to have another 3/4 rate hike at this point in November, and about 30-some percent, 35%, I think, for maybe a half. So it's not like just because of the jolts today and Bank of England we're going to pivot now, see what's happening. Things are still strong from the Fed's point of view. And tomorrow it should be a very volatile day as we can maybe get a chance to see private payrolls start to roll over a little bit. So, like it's all like the market does always, to the downside, it's going to overreact just as it overreacts to the upside when you have these big swings. Well, I think probably what we're going to see here with earnings coming out in about 2 weeks, and we're going to start seeing some adjustments to that. I would expect to see the market start to whittle out kind of a trading range. That means maybe we go back down to where we were last Friday or close to it, and maybe maybe we're near the top of this one of the trading range right in here. We'll have to see. But I do think that we are, with our cycles, our CTI index, that type of thing, it looks like it's going to bottom here over the next couple of weeks. With we certainly have, I think we're like minus 11 this last week, and we had an avoided market. But we're probably going to see, these things come down and test. We're not. You can see the indicators here on this Dow. His stochastics were down in the single digits for a long time. Not, you can see how long it's going, bumping along the bottom over there. So that's why I said we were way overdue for a good solid bounce up here. Yeah, but we're still, I don't know what percentage it is, but we're still way below the 50-day moving average and everything else. You always, one of the things that technicians will look at is they want to start to see days where the AD line begins to go sideways, and it used to be where the AD line would start to roll over before we made a new high, and then you start to see it turn up before we make a new high. It's not quite as it's easy to tell now with all the program trading, so it's so fast anymore. But with it still making new lows in the AD line, that's telling you that we probably are going to come down here and maybe retest where we were last Friday. We could bounce around there a little bit. Now, if you see it bouncing around there, you start to see an uptick in the AD line. That's a positive. As you start to see that, then you go into MarketEdge and you go to your stock watch list. You put in, make a couple lists of stocks of the ones you already own, and I would also make a list of the ones that I want to own that I didn't have a chance to buy when you saw them take off, back in 2020 and all. And then you can see when we got to an early entry buy, something like that, or if you can see them, you can set some different variables or filters on things, and maybe you want to see something that when it crosses a 50-day moving average, or if it starts to, one of my favorite ones is to put in the 50-day relative strength. I want to see it when one of my stocks start to cross about 1.03, when it starts to outperform the S&P 500 by about 3%, and it's starting to trend upwards. Then that's one that I think I want to start to nibble on, because that means that I'm in a stock or sector or ETF or whatever that's beginning to outperform the broader market, and that's what I want to kind of look at. So again, I wouldn't ring the bell on this and say time to load up, but I do think with where the CTI is headed over the next couple of weeks, as earnings start to roll out here, you're going to see a little bit of increase in volatility. If the days that you see them go down and then we come back up, and say if we're down 400 points and then we end up down 150 or down 200, take notice of those days, because that means you're starting to probably see more institutional buyers starting to come in on those sell-offs and buy a little bit of the dip. That should also be a little green flag for you that maybe it's time for you to start to nibble away. You don't want to have this market down 35, 37%, and then all of a sudden, next thing you know, also we have a 20% spike and you haven't bought a thing. You want to when they're down like that in a bear market, this is from years of experience, you want to start to own some things. And again, whether it's averaging down on some stocks like a Microsoft or something, or just getting ready for some new buys. You're getting to the point here where you want to take advantage of this sell-off, where you can start looking a little bit longer term and be nibbling away at things you want to own in the future.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like to answer in the next Tuesday Tech Talk, email it to support@marketedge.com, or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.